听讲座。I'm Professor Beibei Tang from School of Humanities and Social Sciences. It's my great honor to be the academic chair of this lecture series. Professor of XJTLU Public Lecture is our university's signature event for scholarly communication and knowledge dissemination. At XJTLU, now we have over 45 professors through whom we would like to promote our unique research culture. This public lecture series will be delivered by XJTLU professors from different research fields, introducing their career-long research or providing a comprehensive review of selected research topics, as well as the cutting-edge developments in the field. This lecture series will be offered throughout the academic year to both XJTLU staff and students, as well as the public audience. Through stimulating presentations using plain language, the professors of XJTLU Public Lecture Series will explain complex research topics and bring showcase of our university's research impact and its contribution to our community and society. Today's speaker is Professor Hefei Wang. Professor Wang is currently the Associate Dean for Academic Engagement at XJTLU's Business School. She holds a PhD in finance. She holds a PhD in finance from Stanford Graduate School of Business. Before joining XJTLU, Professor Wang worked at the Renmin University of China as a professor of finance and director of the Financial Big Data Lab. In 2022, Professor Wang joined XJTLU. Professor Wang's research interests include theoretical cooperative finance, dynamic asset allocation, and financial big data. She has a long list of publications in high-impact journals, awarded research grants, and invited research talks. Professor Wang has been awarded Renmin University Excellent Youth Scholar, Excellent Teaching Award at the University of Illinois at Chicago, and the Jinji Lake Leading Talent Award in Suzhou, and the Suzhou Industrial Park Excellent Educator Award. Today, we are pleased to have Professor Wang as the first female professor in our Professors of XJTLU Public Lecture Series. She will present on the topic of information transmissions and big data in finance. Professor Wang will talk about 50 or 60 minutes, and then we will open the floor for questions. Professor Wang.
All right. Thank you, Professor Tan, for the very nice introduction of me. And thank you to all of you for being here, given the heavy rain outside. I'll try to make this talk as enjoyable as it can be. So the topic today is a central topic for finance research, information transmission, and how the use of big data would help with this research. So the audience today, I guess, could be students or alumni who are thinking about doing a PhD, or parents who may hope their kids may one day pursue an academic career, or the general public, general audience who may be interested in finance or simply interested possibly to learn something about making money in the financial market. We'll talk about that. So my talk will include the following 4 parts. First, I'll talk about what academic research in finance is about. My own research applies the theory of information economics to financial settings. So I'll talk about what information economics is. And I'll talk about 3 of my recent papers. Professors love to talk about their research. I'll be careful watching my time. All right, so what is academic research in finance about? So first of all, this is the first time I'm giving a talk about my research to the general audience. I think this is very meaningful, but also it's very challenging. First of all, I think many people are interested about topics in finance in general, but there's also some misperception about what finance academics do. So do we spend 5 or 6 years in the PhD learning about how to make money? Or do finance professors spend all of their daytime researching about how to make money? So since our university leaders are here, well, the answer is fortunately no, or not quite, right? So what is finance about? I see some of my students here, and I talk about this in my class. I hope you still remember. Do you? All right. So what I teach in my class is finance is about decision making under uncertainty. And this is more or less what finance academic research also centers around. And in terms of academic research areas, it's generally divided into 3 research areas, including asset pricing, corporate finance, and market microstructure research. So asset pricing, as its name indicates, is about pricing of different financial securities, including stocks, bond, derivatives, which is options futures, commodities, oil, gold, lumber, real estate, which is the housing market, or alternative assets, such as arts, or more recently, Bitcoin, or the non-fungible tokens, or more broadly speaking, anything that can be traded, right? Say a piece of land in the metaverse, right? And students have been talking to me about this really interesting market where people trade sneakers, okay, sports shoes, right, to make a profit. Okay, anything can be traded. Financial economists are curious about how to price them, right? So that's asset pricing. And actually, it is true that many of the research in asset pricing can be turned into trading strategies, and perhaps some of them may make money. However, my research focuses around the second and third topic, which is corporate finance and market microstructure. So corporate finance research involves corporate financial decision-making, okay, including the financing decision, investment decisions, investing decisions, or merger acquisition decisions. So the headline news from last year was Elon Musk taking over Twitter, okay? Merger acquisition, or firms going IPO, corporate governance. Okay, do we have enough female directors on the board, right? So topics like that. And market microstructure involves studies individual trading behavior at a more micro level. So how do traders decide, okay, their strategic actions? And how their trading behaviors affect the price formation, and this is also related to the high frequency trading research, okay, which some of you might have heard of. And in terms of research methodology, it's further divided into theoretical research and empirical research. So theoretical research involves financial modeling using theories from, say, game theory, contract theory, and this is what much of my research is about. There's also the empirical research that works with data, using tools from econometrics and more recently machine learning. So in the recent years, I've also been doing some work, doing some empirical work that I'm going to talk about today. All right, so for my own research, I applied the theory of information economics to financial settings. So what is information economics? Okay. So for those of you who have taken Econ 101, would be very familiar with the concept of adverse selection and moral hazard. Okay, but in my experience, many of you may not actually understood these topics as well as you thought. Okay, I was an economics major when I was in college. I majored in mathematics and computer science, but I took some courses in economics, and these concepts actually weren't precise to me until I took a PhD level microeconomics course, where these topics were further described as hidden information and hidden action. Okay, so you can think of hidden information being how smart you are, okay? Hidden action being how hard you work. Okay, but the market usually doesn't observe those directly. What we see is your productivity, right? So there are the two economists who who did some pioneer work in this area are George Akerlof and Ben Holmstrom, and they were both recognized by the Nobel Prize Committee. Ben Holmstrom is one of my all-time favorite economists. His models are just simply elegant, so I was really glad when he finally won the prize in 2016. And so George Akerlof, in his, I believe, 1970s paper, the classic paper, Market for Lemons, raised the question was the first to bring up the problem of adverse selection. And the setting he studied was in the used car market, which is also called the lemons, right? The used car market. So the seller possess information about his car. Okay? There's a reason that he's selling his used car. Okay? So buyer, knowing that the seller possess some private information about the cars, would bid a lower price. So and eventually this phenomenon may lead to a market collapse. Right? So in 2001, 3 economists received the Nobel Prize for their analysis of markets with asymmetric information. So there is Professor George Akerlof on his car made of lemon. He's the one who raised this question of adverse selection. And then the 2 economists who shared the Nobel Prize with him that year each gave a solution to the adverse selection problem. So Michael Spence' solution was to signal my private information by taking costly actions. And this was written in his PhD dissertation. I think he graduated from Harvard. His PhD dissertation was about using education as a costly signal to signal how smart you are in the job market. Okay, so our education level signals how smart we are. That was his signaling story to deliver, effectively deliver the private information we possess. Joe Stiglitz's solution was to screen with contracts. And the setting he studied was the insurance market. So insurance market offer different contracts to different risk class of customers, and customers would self-select different contract. Okay, so that's what we call screening. By self-selection, the customers reveal their private information about how risky they are. Okay, so these are the question and the 2 solutions. So adverse selection, moral hazard, and the solutions to these problems have wide applications in corporate finance theory. So here I'm listing the reading list I gave to my PhD students for their corporate finance theory course. And so we see a whole range of applications of asymmetric information signaling towards capital structure decisions, financing investment decisions, dividend policies, etc. And this is also a field that produced many Nobel Prize winners. So I highlighted their names including Douglas Diamond was the economist who won the prize last year in 2022. Right. So corporate finance theory is certainly one of the most important research areas in economics in general, and is well recognized. What this also means is that this is just a partial reading list. What this also means that for those of you who wants to do a PhD, be prepared to read lots and lots of papers. Right. This is just for partial reading list for one module. All right, so coming back to asymmetric information, so in addition to the two solutions that were recognized by the Nobel Prize Committee, there's actually a third solution. So if you think about it, in real life, how do we get information across? Well, we talk, right? This is what I'm doing here. I'm talking to deliver the information. But the problem is that we say that talk is cheap, right? So people may have all sorts of incentives to say different things. Why would I believe what you say, right? So how do people effectively get across their information through talking? Well, guess what? We can model this. We can study this in economics, okay, by building game theory model. And this was the topic that got me very, very interested in for my PhD study. I spent many years working on this. So in the classic chip talk game, this was first formulated by two economists, Crawford and Sobel, in their 1982 econometric paper titled Strategic Information Transmission. So in this game, theoretical setup, the information sender possesses information about the true state of the world we are in, right? He's going to send a message to the information receiver who's going to take actions, and this action will decide the payoff to both parties, right? So what we see in this setup is that if our incentives, it has to do with the incentives of the person who's sending the information. Okay, if our incentives are perfectly aligned, as we are now, right, information gets across perfectly. Okay, but if we're a little bit misaligned, the information transmission will not be perfect, right? So unlike the two previous solutions, signaling and screening under certain situations can get the information across perfectly, whereas in the chip talk setting, we don't have perfect information. So what we see is that the information transmission is coarse, okay, meaning that we sometimes see categorical ratings instead of a precise numerical score, right? Or carefully worded sentences, as we say, right? So information transmission is not perfect in this case. It has to do with the degree of conflict of interest. So what I did was extending this literature of the chip talk game into a dynamic game setting, meaning that the game gets repeated over time. So why would I have the incentives to speak the truth? Well, I have my reputation at stake, right? I have my own reputation and the collective reputation of XJTLU, right? So I studied the reputation building in this context. I also extended the chip talk game into a more general continuous time setting. So this is what I did in my earlier career. So this stream of research is actually very theoretical and mathematically challenging. So for my students out there, for your undergraduate or master level thesis, I actually do not encourage you to pursue this stream of research because you don't have the background for it. But for PhD level research, I think this is still a very interesting field. All right, so for the talk today, I'm going to talk about something that's some of my latest research and something that's closer to life, right? So this is the called the market microstructure research. It's a branch of finance that is concerned with the details of how trading occurs in the market. So this is perhaps as close as it can be for you to learn something about trading and making money from this talk. Okay, so market microstructure research, also known as becoming a day trader 101. Okay, from now on. Okay, so what is market microstructure about? Okay, the major thrust of market microstructure research examines the way in which the working processes of a market affect determinants of transaction costs, price quotes, volume, and trading behavior. Okay, this is taken from Wikipedia, and you would be like, wait, what? What was that all about? Okay, all right, so let's take a step back and start to speak human language. Okay, so I'll have to introduce some of the terminology or the language we speak in the financial market. So this is a screenshot of your favorite stock trading software. Okay, so what you see here is the price. Do I have a laser beam? This is not a laser beam. I don't. Okay, I have a cursor here, which you may see. All right, so this is the commercial bank, and we see the last trading, the current price being 33. 33 is the price where the last transaction occurred, where there's a buy and sell, right? And what we also see are these prices, okay? These are 1, 2, 3, 4, 5 buy orders, each at different prices. And on top, these are the 5 sell orders at different prices, right? So this information is what we call a limit order book, right? So these buy and sell, these are called the limit orders. The limit orders, meaning that I specify the price I want to buy or sell at, right? In addition to the limit orders, the investor can also place so-called a market order, meaning that I just issue a buy or sell without specifying a price. The price would be the market price, okay? So limit order has buy and sell with the price. Market order is only buy and sell without the price, right? So how would the price be decided? Well, if I'm buying, if I send a buy market order, then my order will be matched to the lowest selling price, okay? The lowest selling price, that would be the transaction. Okay. So we see that these buying orders, buying limit orders, these prices are what we call the bid price, okay? Some price that someone is willing to buy something for. And then the sell prices are what we call the ask price. And there's also a difference between the bid and ask price. This is called the bid-ask spread, okay? So in this case, the spread is very narrow, okay? But let's look at another one, okay? Again, your favorite stock, multi, right? And in this case, if you look at the buy and sell, well, there's a gap, okay? You can't really read it, but there's a wider, what we call the bid-ask spread, okay? So market microstructure research is to study how do traders make these decisions. Will they place a market order or a limit order? Okay, at what price are they placing this order given the information we possess or given the information that's in the financial market, okay? And how their decision affect the prices that we observe. So I'm gonna first talk about one of my earlier theoretical paper that studies actually the transaction tax in the context of market microstructure. So financial transaction tax is that when you buy or sell a financial security, you're being taxed. Okay, so government usually do that. The purpose is to generate revenue for the government and also to discourage excessive speculative trading. Examples of the financial tax would include the very well-known, very famous Tobin tax, which is named after James Tobin. He won the Nobel Prize in 1981. The original Tobin tax was a tax in the foreign exchange market. And in his famous words, is to throw some sand in the wheels to stabilize currency market and discourage short-term speculative trading. And more recently, France and other European countries also introduced some form of the financial transaction tax. So the goals of such tax is set to reduce price volatility, raise revenue from very small amount of tax, solve the problem of too much trading, encourage long-term investing, and perhaps also push out the harmful speculators out of the market. So these financial transaction tax has supporters from policymakers such as the former U.S. Secretary of Treasury, Larry Summers, the former German Chancellor, Angela Merkel, and there are also opponents. The opponents of such financial transaction tax are usually the academics who argue that, well, wait a minute, it might also have negative effects, okay, which includes reduced financial security values, reduce the general amount of trading, distorts the market, and perhaps push trades to other venues or countries, okay? So since the debate is contentious, we try to build a theoretical framework to provide some guidance, okay, analysis to this question. All right, so in terms of the modeling, well, if tax changes the decision of these investors, then strategic action is the key, okay? So we want to study how the transaction tax will change the trader's behavior between choosing a limit order or a market order, okay? And this model would allow us to study what comes out of the endogenized market phenomenon and offer insight into how market quality would change with the tax. All right, so let's briefly talk about the model setup just to give you a sense of what finance theoretical research is about. So don't panic if you don't fully understand everything. Well, we spent close to 2 decades building up knowledge, but hopefully it'll give you an idea about what how we carry out such research. Right? So in terms of the model setup, we assume that the asset we're trading has an intrinsic value V, and we have a sequence of identical traders entering into the market, one per period. Okay, so this kind of sequential structure would be a good approximation, especially in the high frequency setting. Okay, when this transaction is very quick. Okay, we tend to observe one trader after another. So the trader could be investor or market maker. So investor invests based on their valuation, and investors do not all have the same valuation. Well, that is why trading will occur. Okay, so if you think about the last price, the last transaction price, some people think it makes sense to buy, some people think it makes sense to sell, right? So it's the disagreement in the valuation makes trade happen, right? So traders have different valuation, and we model this as the valuation follows a probability distribution. The market makers are just in to facilitate trade, so they don't have a valuation. They're being neutral. And each trader is taxed at TEL. This is a tax per share at buy or sell. Right? So traders will strategically choosing whether they want to place a market order or a limit order. And if they place a limit order, they'll have to provide a bid and ask price. So consider we have 3 traders coming into the market at different times, one after another, Elsa, Rick, and Sam. Okay, so in this price maker-taker model, Rick, the guy in the middle, strategically chooses between either he wants to trade Elsa's quote. In that sense, he's just sending a market order saying that I'm taking Elsa's quote. Okay? Or if he doesn't like what he sees in the market, the current market price, he's going to say that, okay, forget about the market price. I'm going to provide my own price quote. Okay? So Rick is also going to decide his optimal level of the price that he's going to quote for the next trader, hopefully who will transact with him. Okay, so when choosing this, he has to compare the expected benefit that of these different actions. Alpha is in the same position, right? So, so if Alpha sends a market order, that means that Alpha is trading with the trader before her, okay? Taking the previous trader's quote, and that would be the end. Or Alpha can send a limit order by providing a buy and sell price, but a transaction may not happen, okay? There will be a trade only if the next trader, Rick, decides to send a market order and trade with her, okay? Take her quote, okay? So now the problem becomes interesting. The game is played every period between the current and the next period trader, and the solution takes a form that does not depend on, say, the previous days, meaning that whatever the price has changed earlier does not matter for my decision, right? So we call this a Markovian problem that only depends on now and the future, but not the past. Right? So the optimal trade strategies will be decided working forward. Okay, so Elsa has imperfect information. She knows her own valuation. Okay, she knows how much she's valuing, but she doesn't know the next trader's valuation. Okay, so she has to form an expectation. Okay, she has to form an expectation. So this is where things get interesting because it's she has to figure out the probability that Rick would choose to trade with her if she decides to quote instead of trading right now with the previous trader. Right? So we're able to show in this setup, okay, we build this model, and we're able to show the existence of what we call a Markov perfect equilibrium and the existence of a unique Markov perfect equilibrium when there's continuous cumulative distribution function. All right, so let's cut to the outcome. The result of this model is that we show that, well, tax is associated with all sorts of problems, including it reduces the value of trading, okay, providing liquidity, quoting, increases the bid-ask spread, okay, increases the price volatility, decreases the asset value, and reduces the likelihood that a trade would happen. Okay, everybody is providing a wider quote because tax is eating up revenue. And if we introduce market makers into the model, then the game, then things get more complicated. That the presence of market maker actually amplify the effect of tax. Okay, and we also see some linearity here. And finally, if we model the distribution, the reservation value as a normal distribution, then, well, we start to see that if the tax is low, okay, then in some cases, the introduction of the tax could reduce the market volatility. Okay, but this kind of policy has to be carefully designed. Okay, only when the tax is low and in market, without many market makers, then we see some reduction in volatility. But in other cases, okay, we see the opposite effect. And this phenomenon, this model outcome is actually consistent with the empirical findings of these countries who introduced transaction tax. Okay, empirically, we see actually inconsistent outcomes from different countries. And this model may explain why. Okay, the level of tax has to be carefully chosen, very carefully chosen. All right, so that was a theoretical work, and now I'm going to talk about a empirical work. And so this is based on Chinese data, and it's also, the paper is actually also written in Chinese under this title. It's been circulating around under this title and it's currently under review at a top Chinese journal. What we did in this paper is we're looking at the high frequency limit order book data. Okay, so so it's actually, so this is the limit order book, buy and sell. And then at the high frequency level, we see this. Okay, so this is at a 5-minute frequency, 10 years worth of data. What we try to see here is that where do traders want to place their order, okay, at what price? Okay, so we have the buys, we have the sells, and then we have the mid price. Okay, if you're closer to the center, then you are more likely that your quote is going to be transacted. Okay, so the closer you are to the middle, the more likely it's going to be traded. But then there are also other traders who strategically place their order further away from the mid price. Okay, we will say on the outer of this limit order book. Okay, why do they do that? Okay, we argue that if the traders are uncertain, or if they know that the future risk level is going to be high, they would strategically place their order towards the outer side of this limit order book. If they're certain about the future, then they want their trade to be transacted right away, then they'll put their price closer to the inner. Okay, so we came up with, we want to ask, well, this kind of information, can we come up with measure that's going to allow us to extract information about future risk levels? Okay. And indeed, with the measurement that we came up with, we are able to find predictability about the future risk levels. So more specifically, the greater fluctuations in the order imbalance and the difference between the inside and outside orders do indicate higher future market risk, and we found evidence for that. But this is just one dimension of the information that we are extracting, and there are actually many other things that we can study with this data. All right, so for the remainder of the talk, I'm going to talk about big data in finance. Okay, since this is a trendy topic that many people are interested in. But by the time I got to this part of the PPT, it was getting a little bit boring. So I asked ChatGPT to tell me a joke about big data research in finance. Okay, and this is what ChatGPT said. That why did big data analysts in finance bring a ladder to work? Because they needed a way to climb the data mountain and reach new heights of financial insights. Well, not so funny, all right? I don't know if you found it funny, but okay, all right. It's a nice try. And it actually does contain some truths in this statement, right? So what we see is that our physical world has becoming increasingly digital. And if we collect the data in our digital universe and store them in a 128 gigabyte iPad Air, okay, all of the data, and put them in the iPad Air and stack them up, okay, we'll make multiple trips to the moon, okay? So we do need a very, very tall ladder to climb the data mountain. And actually, many firms I talk to feel like they're sitting on top of a data mountain of gold, but they don't know how to dig, and they don't know what to look for, right? So machine learning actually has provided us tools to work with these bigger data sets. So in the in machine learning, we have the supervised learning, unsupervised learning, and I think by now most people know what they are. But that's actually not the point of this part of the talk. So how do we how is machine learning used in finance research? Okay, so as a pricing research in finance is mostly about return predictability. Okay, can we predict returns using the current information, or what we call the information set? Okay, or more technically speaking, is this conditional expectation of the product between the return and the stochastic discount factor. Okay, so this by itself is a natural because we have this expectation equal to 0. This is what we're trying to test. This is actually natural supervised learning. Okay, and we also have the dimension reduction of our information set. Okay, which is all the information we have. It's very high dimensional, so we can use machine unsupervised learning to reduce the dimension of the information that we're working with, right? But we want to be very, very careful when we use machine learning in finance, because unlike science and engineering, some fields in science and engineering, so if we observe the market, okay, as market observers, our economists as market observers, if we have better tools to observe the market, we need to understand that what we observe, the market participants, are also using better tools to generate trading strategies, which will change the price behavior. Okay, so this is what we say that is something similar to the Lucas critique. Okay, meaning that the thing we observe changes with the tools or policies. Right, so this is unlike facial recognition. Okay, it doesn't matter what algorithm I use to study your face. Your face doesn't change with what tools I'm using to observe your face, right? But the financial market does not, it's different, right? So using machine learning to beat the market is actually in some sense much more difficult than facial recognition. All right, so this is one of my latest paper that uses deep learning to study investor sentiment and stock prices. This is based on Chinese data, and it was published towards the end of 2001, so a little bit over a year and a half, and I'm getting over 100 citations. And actually, citation went up again today, this morning, as I checked. And that is actually a very good citation number for a finance journal, right? For a finance paper. It means that this area of research is still very, very active. Okay. So what we did in this paper is that we're collecting, well, this was one of the earlier papers that did this kind of research. Well, by now, I mean, many of my undergraduate students are doing similar research, but that was in 2017, and we submitted in 2019. It took 4 rounds of review. It took 2 years to publish. So we have 260 trading days of data, and we collect the stock forum messages from eastmoney.com. What we did was for each experimental trial, 5 stocks were randomly selected from each of the 6 major industries. So a total of around 880,000 posts, okay, per experimental trial. And we did 20 experimental trials like this. So it's indeed like big data. So what we did is that we used 2 neural networks. One is a convolutional neural network as a classifier to classify the sentiment. And then we feed them along with other time series into a long short-term memory neural network. Okay, so financial time series data is actually very noisy. Okay, it has a lot of noise. So the long short-term memory model has this forget gate that allows us to filter out the noise, so which is good for financial time series data. And we did find pretty good the return predictability in this case, okay, for the Chinese stock during that time period. However, we need to be cautious about the result, okay? So the high accuracy for the Chinese market may be due to trading restrictions such that such trading strategy cannot be easily implemented. Okay, so what we did was that we took the closing price, daily closing price of today, and all of the stock messages for today and process them. So this happens after the market has closed. And then we predict tomorrow's closing price. Okay, so to take advantage of such strategy, this involves trading in the same day. It has to have trading has to happen over the same day tomorrow. Okay. this is what we call a T+0 trading strategy, which is actually not allowed in China. I mean, there are some ways to overcome it, but not to a very large degree, right? To the magnitude of such strategies is actually very limited. Right? So the point here is that finding market predictability for those that are not implementable is actually not uncommon, right? So this will be an example of what we call the limits to arbitrage. Okay, so it may occur that, okay, we found very good predictability, right? But then if you take a closer look, well, it's actually very difficult to exploit such predictability, which explains why such predictability exists in the market, right? So that would be a common mistake that I see that some of the students make. All right, so well, I managed to talk about the 3 papers I want to talk. And this is the last talk before summer. And a final word to those who want to pursue a career in academia. There's this perception, again, maybe misperception, that academics' life is very free, all right? Yes, we don't have a boss watching over our shoulder all the time. So many people may think life of academics is so free that every workday is actually a Saturday. But if you talk to the academics, we feel the opposite. We feel every Saturday is actually a workday, right? So when summer vacation comes, professor would be like, oh yeah, I can finally get to work on my research, right? But I guess if you enjoy what you're doing, then every workday is also a vacation, no? All right, so with that, I conclude my talk. Thank you very much.
Thank you, Professor Wang, for your interesting talk. To the audience online, we will stop our live streaming here. We will enter the questions and answers. Professor Wang's lecture today is the last lecture of our public lecture series in this semester. We will resume our XJTLU Professor Public Lecture when the new semester starts, and we look forward to seeing you again. Thank you for staying with us, and we wish you a good night and a good summer. Thank you. And now we open the floor for questions. Yes.
You talked about the impact of information on trading and